Good morning. Welcome to Trading Hour. It's a Wednesday morning. The time is 11 o'clock. The markets are subdued for the benchmark indices. Not lost too much, just down about 0.2%. But the story is in the broader markets and its outperformance yet again. Mid-cap index is up nearly 0.5%. And now so far, week to date, the Nifty is down about 0.4%, while the mid-cap index has surged 1%. Hi.
Hi, Rima. And it's been that kind of a week as well, right, for the markets. It's neither here nor there. And this is a very important session also because it's a sandwiched session. We had a Sensex monthly expiry yesterday. We have a Nifty monthly expiry tomorrow. So it would not be a surprise that we remain where we are currently and we continue to be in this dull drab range that we've been in. And the actual action tapers out over the last 2 days. Of course, we are looking forward to some very important global cues as well overnight with the Fed minutes and of course the Nvidia results that will be reported after market hours in US times. So we keep an eye out on that. Of course, not to take away from the fact that, as Rima was highlighting, plenty of action in the broader markets and Techno-Electric is one of them. We'll get Amakshi over the course of the show for more details on this. 10% higher on that stock. It's the top gainer on the Nifty 500. And Triveni Engineering, we just heard the management a few minutes earlier on the channel, 8.5% higher on that stock as well. But can't say the same for Gujarat Fluoro. A downgrade has come in from DAM Capital earlier this morning, so 5.5% lower on that stock as well. And Bharat Dynamics, of course, margins being way off the mark compared to what the management had guided for the full year. That stock trading around 3.25% lower. But so far, so good. There is no reason or no dynamic moves that we have seen in the market so far.
Indeed. And remember, we're coming to you live from the CNBC-TV18 Motilal Oswal studio. And let's get the show started then. And right on top, we've got a conversation coming up as the UBS Asian Investment Conference 2025 is underway. And Naveen Killa, who is the head of APAC Telecommunications, Media and Internet at UBS Investment Bank, is now joining in with his thoughts. Thank you very much, Naveen. Look forward to this conversation. You recently met with 30 investors in US and Canada. And you spoke to them about the India telecom internet space. You compared it with the rest of the Asian peers. What were the big key takeaways?
Absolutely. Still jet lagged, actually. So look, on the India internet space, which is where the conversations are a lot more, I think the discussion centered on two main things. First is the extremely high competitive intensity that we are seeing in the quick commerce space, particularly in the last 6 months with the entry of several new platforms. Investors are obviously a little worried about that. But at the same time, they are also mindful of the long-term substantial growth opportunity in the quick commerce space. And therefore, I think at the end of the day, I kind of sense that there is a positive bias, but maybe they're on the sidelines for a little bit. On telecoms, I would say there are probably three main things that people are discussing. First is tariffs, which have obviously gone up a lot in the last 4 or 5 years, but there is an anticipation that they can keep going up. But as the base gets higher, is it easier to keep increasing prices at the same pace? There's obviously increasingly a lot of questions around satellite broadband, given the recent deals that both Bharti and Jio have announced with SpaceX, and what could that mean in terms of technology evolution and roadmap. And then finally, with telcos in particular, there is always this conversation around cash flow generation, which the sector tends to generate a lot, and what that therefore means in terms of the utilization of that cash for future investments versus dividends.
Okay, so those were the questions, Naveen. Now it's your job to give us the answers to that. So let's talk about the internet space. Without getting into stocks, broadly you're bullish on the two internet, quick commerce kind of stocks like Swiggy and Zomato. The UBS view is a buy call on these stocks. Now, as you pointed out, investors are concerned about the rising competitive intensity. The numbers show the losses are deepening in the quick commerce side of the business. What would your answer be to that? And why are you bullish in this space?
So I would make two observations. One is you do need to look at the size of the pie, which is expanding at the rate of 100% per year. And I think we are constantly redefining what is quick commerce. A year ago, we would have said quick commerce is basically concentrated in 30 cities, predominantly centered on groceries, and mainly focused on 15-minute deliveries. All three of those assumptions are changing today. Quick commerce is available in closer to 100 cities. Categories are expanding way beyond groceries, and platforms are going into 30-minute, 45-minute deliveries as well, which expands the market in a big way. So the first point I would make is that the total addressable market, or TAM, here is very substantial. And that is something that we obviously have at the back of our mind. Secondly, in terms of the cash burn and the losses that you talked about, So there are two drivers of that, right? First is the increase in marketing costs, which we are seeing some signs of stabilization. Again, there will be some quarterly fluctuations, but we think the worst of the competitive intensity is behind us. The second and the bigger driver of margin decline is the rate at which new dark stores are being built, because that brings a fixed cost in the system, and it takes a dark store 3-6 months before it gets the scale that it needs to become break-even. That pace has been extremely rapid in the last 6 months. But our view is, again, that is starting to peak just because of the size that they've reached. As I said, we are already in 100-odd cities. So as these two factors start to play out, again, it's tough to say which quarter it is, but we are probably very close to the bottoming out of that margin trajectory, and that explains our positive view on the space.
Naveen, good morning. Thank you for joining in. Firstly, before I get to more granular details of the telecom space, there has been this lingering threat/opportunity of satellite communication becoming a part of the Indian system, and the incumbent telecom players have expressed their views on what it should be. But do you see this as an opportunity, or do you see this as a threat for the incumbent telecom players in India?
So, I mean, the first caveat I must add is that this technology is evolving so rapidly that we honestly have no idea how things will evolve even 2 years out. But that being said, what cannot be denied is that the cost per GB for satellite will always be a multiple of what it would be using your traditional mobile broadband technologies. And in a price-sensitive market like India, I think that will always be a bottleneck to massive adoption. I think the fact that we have started seeing telcos doing deals with satellite operators rather than the satellite broadband operators coming separately in the market kind of proves that at the end of the day, the telcos start to see this as an additional service. So think of today a network that does not reach maybe 5 or 10% of the population. The satellite technology can help you get there, monetize that part of the business, and also help you manage the capex that you otherwise would spend to cover extremely remote areas in the country. Of course, in return for that, you might have to share some of your revenues with the likes of SpaceX. But in the context of the premiumization from better quality and just the fact that there are extra customers that you can cater to, I think the upsides can easily kind of offset the costs. So as of now, our view is that it's probably going to be incrementally positive. But if the technology evolves to a point where the cost per unit is comparable to mobile broadband, then I think obviously the conclusions will be very different.
But as of now, you don't see that possibility. But are investors baking in any upside for, say, a Jio, Bharti, any of the incumbents on account of satellite communication, or not yet?
I don't get the sense that they are. And I think the reason for that is, remember, at the end of the day, India is a reasonably well-covered market, right? So from a population perspective, you have more than 95% population coverage of 4G and 5G networks. So ultimately, what you're talking about is a very small subset of the customer base that could be incremental. I think the opportunity that could be bigger is if you are able to charge more to the customers by giving them the proposition that you now have 100% geographical coverage. And whether the customers will be willing to pay for that, because you do not always go into areas where there are blank spots. That opportunity could be a lot bigger. The incremental customer opportunity is marginal.
Got that. Well explained. Naveen, one final question. For an emerging market investor who has a choice to invest in India Telecom, India Internet stocks, and the comparables in Asia Pacific, what would the pecking order be? Where would India stand in that? How would the valuations versus growth stacked up?
So I would say, first of all, remember at a time of massive global macro uncertainties, we are definitely seeing investors who are looking for businesses which are immune to some of these external factors like currencies and interest rates and all of that. And positively speaking, both telcos and internet actually fit into that. Domestic businesses, largely local currency revenues and largely local currency cost bases, and much better balance sheets. So I would say the whole space kind of fits in well within that thematic of being unimpacted by the broader macro. That being said, I think in terms of your pecking order, I would say that, from a longer term upside perspective, we clearly have a preference for internet. Both the customer growth as well as the revenue opportunity there is very substantial. Telco is a relatively mature business, but obviously one that gives you solid cash flows. So our pecking order would be India Internet first, followed by India Telecoms.
All right, Naveen, thank you so much for sparing time and joining us today with your views on both the internet and the telecom space as well there from the UBS Asian Investment Conference 2025. By the way, the Nifty continues to remain 50 points lower, 170 down on the Sensex. So it still continues to remain in that very narrow range. Does the index in today's trade as well. Take a short break, but on the other side, all things commodities with Manisha Gupta. Welcome back. Just mentioning a few minutes earlier about Techno Electric being the top gainer on the Nifty 500, 11% higher on that stock. Very strong quarterly results coming in from the company, and Vamakshi is here to decode just that. Vamakshi, good morning.
Good morning, Hormaz. Good set coming in from the company. When you look at the revenue growth, that has come in very strong at almost 86% on a year-on-year basis. When we look at the gross margins, however, they've contracted by around 91 basis points. But given the kind of decline we've seen in other expenses, and the total expenses growth as well was not as much as the revenue growth. So therefore, what we're seeing is that the EBITDA margin has actually expanded by 315 basis points, resulting in a 133% jump in the EBITDA, which came in at almost 127 crores. The net profit too, given the kind of growth that we've seen in other income, is also seeing a very sharp uptick of almost 74%. In fact, the whole second half for the company has been quite robust. But when we look at the company's numbers on an annual basis, revenue is at a multi-year high at 2,269 odd crores. The EBITDA margins too have improved consecutively for the third straight year, and in fact they are at the highest level seen since FY22. And the cash flow for the company, which was negative in the prior year, has now become positive. All of this bodes well for the company. Therefore, we're seeing a very strong uptick.
Thank you very much for that. Now let's shift our attention to commodities. Manisha is now joining in and she's looking at gold this morning. Manisha.
Thank you for that, Rima. Well, I am, because we have seen gold prices continue to decline further. Last week was a great one. We saw 5% of gains coming in, and at one point in time, you also thought that we were perhaps heading towards that 3,400 mark. But in last couple of sessions or more, we've seen prices continue to decline. 3,300 just about holding on your screens now, and the markets are looking at the rebound in US dollar index that seems to be weighing on. The global equities are doing better. So the risk-on situation also has led to money coming out of gold and into various other asset classes. The other point also is that there's just so much data coming in between today to Friday, and the street will react to that. You have the US Fed meeting minutes that are going to be released today. It also is about the US first quarter GDP estimates, PCE data, weekly jobless claims. All of those numbers are slated tomorrow and day after as well. So ahead of that, there's a bit of choppiness that you have seen in gold. But interestingly, all the global banks and brokerages that I have been talking about are saying that while, yes, you could be looking at some cyclical bearishness in case of gold prices for the next 3 or 5 months, but longer term, the structural bullishness has just about continued. Citi, for one, says that $3,500 an ounce is coming back for gold prices. 31 to 3,500 is what they're talking about. Bank of America is talking about $4,000 an ounce in the first half of 2026. You also have Saxo Bank talking about 3,800 as a possibility in the first half of 2026 as well. So bullishness has just about continued. This is a statement from Citi yet again, which says that 0.5% of world's GDP currently is being spent on buying gold, which is the highest in 50 years. So this is inclusive of retail buying, physical buying, central bank buying. We've also seen digital gold buying happening as well. Fund of funds also are reporting big gold buying happening there. So we are looking at very strong buying even as the prices, and especially as the prices come off.
Not enough upside triggers, but enough to keep the downside capped. Manisha, thanks a lot for that update on gold. But moving on, then continuing with corporate conversations, Yatharth Hospitals saw a strong year-on-year revenue growth, the 20% growth there. Margins also expanded on a year-on-year basis. However, the net profit was impacted due to higher depreciation and finance cost. Yatharth Tyagi, the whole-time director at Yatharth Hospitals and Trauma Care Services, is now joining in to discuss the road ahead for the company. Yatharth, good morning. Thank you for joining in. So, firstly, your average revenue per operating bed went up this quarter. Your occupancy also went up this quarter. What would you attribute that to? And what are your ARPOB targets for FY26, if you have set any?
Hi, so it's been a good financial year for us, especially the way quarter 4 has panned out. the company has shown upwards of 30% YOY growth, both in terms of the quarter as well as the financial year 25. I think this is primarily due to three aspects. One is the growth in our Nod extension as well as the Jhansi Orcha hospital. Both these hospitals have shown upwards of 25 to 30% growth, which has led to the increase in the ARPOB as well as occupancy in these specific hospitals, contributing to the overall performance of the company. As well as if you look at the EBITDA margins, we have been close to 25% at the yearly basis, and this is as per our expectations. Talking about the ARPOB growth has happened, around 8% year-on-year basis. And again, this is what the company has also shown in the past for 2-3 years. We still feel that there's a huge scope in terms of ARPOB going forward, as to three major reasons. One is the increase and changes in the case mix. So as most super specialty treatments are now increasing in a pie. So for example, oncology has increased. Now oncology is almost contributing close to 20%. So these are high price specialties. Due to growth in these specialties, ARPOB is increasing, and we do feel in the years going forward, we should see a similar trend in the ARPOB growth that we have seen for the full financial year.
Yatharth, hi, Rima here. Just a few questions then. You've been largely maintaining a 30% kind of a revenue growth. Will that sustain even in FY26?
See, we are also adding capacity this year. So 2 of our new hospitals are going to start from literally next month. So their revenue should start flowing at the beginning of Q2. So we are starting a hospital in New Delhi in an area called Model Town. So 300-bedded hospital starting there, as well as our second hospital in Faridabad, which is going to be a 400-bedded hospital, is also going to start. So with 700-bed capacity, being added up for the whole financial year, we do expect a good momentum in our overall revenue growth, and we do expect the trend that we have seen for the last 2-3 years in our year-on-year percentage growth in the revenue should be sustainable for the next few years to come.
Okay, revenue growth sustainable, and that's been about 30% on an average for the last many years. And now that you have 2 hospitals coming on stream in the next 1 month, will the margins come under pressure? Will you initially face any sort of increase in operational costs which could hurt margin, or can you hold on to 25% margins for the full year?
So if you look at our margins for the Q4, we are close to 24.5%. And I think the margins in Q4 would be a right assessment for the quarters going forward, because yes, we do have 2 hospitals starting, but the another hospital that we started a year ago in the city of Greater Faridabad. So that hospital has almost EBITDA break even in the latest month. So the losses of that hospital will now stop, and that will start adding to the EBITDA. So overall, and even in our existing mature hospital, there's still occupancy ramp up yet to be seen. Both Nod Extension, Great Noida, we do expect occupancy increase further. So that should be covering up for the losses for the new hospital. So overall, we do feel the EBITDA margins that we have seen in Q4 should be the right momentum going forward, would be something similar for the whole year forward as well.
Yatharth, just before we get back to business, there were reports late last year, earlier this year, about the income tax department involved with the company, and you had also issued a clarification that there has been no new updates on that earlier this year. What's the status of that currently? If you could share an update on that.
So, as far as the income tax case is concerned, there's a huge positive development that happened for the company in the latest quarter. So one of our subsidiaries, AKS Medica, which comprises of the Nod Extension Hospital business, and it contributes nearly to 40% to the overall group. So the audit for that is almost complete now, largely complete, and the demand there for the tax that the company would be paying is minuscule. It's in the tune of only around 1.5 crores. So we are quite confident now with the subsidy, and our other subsidies contribute very less. So it's mainly the AKS Medica that was contributing 40% of the overall revenue. So the audit for that is largely settled now. So going forward also, we do expect for the parent company the settlement to be not impactful for the whole company. And we have always maintained that we do not see any large financial impact coming in, from the case going forward as well.
You also mentioned that there was some attachments, provisional attachments, and the use of around 6 crores from the pledged amount. Has that issue being resolved, and do you see this entire issue getting resolved in the first half of this year, Yatharth?
We feel that before the end of this, calendar year, we should get this issue should largely be settled, and that is the timeline what any income tax matter takes. So when the case started, we always maintained that before 2 years it should be settled, and we are pretty much on the timeline. So we feel that once that's settled, any attachment will also be removed. Just to remind you, these attachments are anyways provisional attachments, right? So now because the demand for the AKS Medica is there, so once we do that tax deposition, that provisional attachment will also be removed from the subsidies, as well as going forward, as I mentioned, that before the end of this calendar year, we do expect largely for the whole case to be settled very soon.
Got that. Just one word answer, if you could. Do you think you spoke about how RBOP is seeing a positive momentum, will continue to increase? 8 to 10% should be the annual growth one should estimate for an increase in the average revenue per occupied bed?
I think we can take that figure conservatively to be there for the next few years.
Okay.
Because,
Right.
yes, international patients are also going to increase in our hospital. So Greater Noida is coming up with Asia's largest international airport. So we are the closest hospital to the airport. So with that going forward, our RPOP expectancy should increase much higher.
Okay, we'll leave the conversation here, Yatharth. So some of the key takeaways are revenue growth momentum should continue. It's been 30%. Q4 margins around 25% should sustain. The 2 new hospitals, which add 700 beds, should come on stream in the next 1 year. In the next 1 month, the company conservatively can add about 8 to 10% to its average revenue per occupied bed on an annual basis for the next 2 to 3 years. And the tax matter process is on, but should get fully resolved in this calendar year itself. But that's Yatharth Hospital for you. Moving on, we're excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon every day for the Global Reset, and then again at 8:30 p.m. for Global Lens.
Welcome back. 24,750 is where the index continues to remain. A 70-point downtick so far. The Sensex is down 230. So not significant moves there for the index so far. Currently trading near the lowest point of the day. Mitesh Thakkar joins in for a quick chart check. Mitesh, 24,750, do you see that becoming a support for today's trading session? And if not, what are the key levels for the index and your stock recommendations as well?
I think my belief is that, we might actually see the Nifty to a range of 24,500, 450 to about 25,050. So maybe slightly lower. And on the stock side, I have a buy on Gas Authority of India Limited with a stop at about 193.5 for targets of 202. While DMart or Avenue Supermarkets is a sell. Keep a stop about 4,100 and look for targets of around 39.60.
Thank you, Mitesh, for that. Get into a break. On the other side, market discussion lined up with Manish Dangi from Mosaic Asset Management. Welcome back. Manish Dangi from Mosaic Asset Management is now with us to join to talk more about the markets and macros. Manish, thank you very much for joining in. Just last week we were discussing, not with you, but the markets were worried about the U.S. bond rout. Trump's tax bill, Moody's downgrade of their U.S. credit rating. How are you assessing the U.S. macros first?
Hi. So the U.S. essentially, the whole thing of the MAGA that they've got the tax cuts, but spending cuts are not coming in, and so to that extent, the old US template of good last 10 years of running very high fiscal deficits seems to continue even in this regime, and which is why, bonds are not liking it. Rates have backed up substantially in US since Trump came in, and that continues to sort of happen. All of that actually impact is more visible in places like Japan, where the bonds are actually backing up even more substantially. So in a sense, it's for the bonds. You sort of intermittently in US at least, it doesn't seem to, you don't seem to have policy support. Is how I can read it. Every time it sort of seems like that they're going to be growth slowdown, and which will result in lower rates, and therefore the long bonds actually start to price in. They price in also, and there comes a little bit of a fiscal googly, and you sort of see rates back up again. So that's how one has to read it. It seems US does not have the sort of appetite to actually tighten fisc at any given point in time. They lose. So that's how I would read the macro there.
Manish, good morning. Thank you for joining in. Does this mean, with this current bond market volatility that you're witnessing, that the longer tenor bonds are an absolute no-go? Because the 40-year bond auction that just happened in Japan had a very poor response. Even the 20-year bond auction that happened in the US earlier this week, that too had a very poor response. But the 2-year bond auction that happened yesterday, that had a very good response in the US. So it means that the shorter tenor bonds, okay, but the longer tenor bonds right now is an absolute no-go, considering you just don't know what's going to happen in that long.
Yeah, so long tenor bonds is where you read the macro right. Short tenor is so much to do with many other things, and of course they are very adjacent to the Fed rates, and liquidity is an issue there. So my sense is that long tenor is where where you have a good resolution of how markets at least read how macro would behave over a medium term, and for equities or for general view of that economy over the next few years. For mortgage rates, what matters, of course, is what long tenor bonds do. It's a mix of things like, the long tenor bonds refuse to believe that US inflation would sustain at low level, but more importantly, they're actually pricing in much higher real rate given the fiscal pressures. And of course, there also have to be pricing in a sustained possibility of sharp devaluation of dollar at some point in time. And so I don't know, what all Trump would be able to achieve, but for sure, one thing that he will be able to achieve is a significant dollar weakness, I think. And that's how I would read, how the bond and the currency are tangoing right now.
Okay, so you expect the dollar to weaken from here on. On the Indian currency, given the fact that RBI is flushing the system with ample liquidity, what is the call on the Indian currency, say by the end of the calendar year, in terms of more cuts from the Reserve Bank of India, and how it affects the bonds?
So with such sharp easing in liquidity, rate cuts, and of course weakness in economy over last 12 months, we initially we saw our currency weaken, but the fact that it's sort of in some sense unwound some of the losses. Sort of tells you that a big global macro trade is supportive of emerging market currency. So my general view for next couple of years would be that the depreciation run rate of INR would be a lot lesser, and I wouldn't be surprised. I would say sort of 1 in 2 chance that INR remains here or actually sort of becomes stronger over next 1 to 2 years. So that kind of a regime invariably does not happen in weak growth environment, but again, tying it with what is happening in US, it's more to do with dollar, and which is why INR actually will most probably stay strong. INR strength or INR stability also gives a lot of space for RBI to actually do a lot of things. Substantial easing in liquidity, rate cuts, and so on and so forth, and regulatory easing. All of that is only possible in last 4-5 months because INR has been sort of last 2-3 months particularly because INR has been sort of stable or appreciating now.
Since you mentioned the dollar, Manish, I was just reading a note from JP Morgan where they had asked a very pertinent question, that is this the start of the dollar downfall? Where they do say that, of course, they are expecting a few more percentage points of depreciation for the dollar. They don't see a very substantial or a significant crash from these levels. what do you think about where's the dollar headed here? It's been meandering around this 98 to 100 range. But do you see the dollar weakening further? And does that mean that emerging market currencies will fare a lot better this year compared to the dollar?
So a couple of things, right? From purely valuation standpoint, dollar relative to any currency, more specifically developed market currencies, is very strong. And so if fundamentals were to sort of get priced in, dollar should be weaker by 15-20%, depending upon how you sort of look at various indices. So that's fundamental. Two, historically also, last 50, 100 years, you tend to see these 10, 15 years of strong dollar and thereafter weak dollar markets. We've had a very, very strong dollar market since GFC. This is 2008. I wouldn't be surprised if we are rolling into a period of weak dollar setup. So sort of that's pure empirical way of actually looking at it. Third, of course, is the policy itself. After very long, almost clearly, the U.S. administration seemed to be hinting that they need weak dollar, and to that extent, all policies would sort of align to ensure that their currency actually weaken in order to, of course, get manufacturing back and so forth, whatever they're wanting to do. So all of these things sort of point at a picture, which is perhaps going to drive dollar weaker over next couple of years. So very, very different regime than what we've seen since 2007.
All right, Manish, thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. We take a short break here, but just before we do that, here's some good news for our viewers. And India's business news leader is now just a click away. Introducing CNBC TV18's all-new app, where you get instant access to breaking news, in-depth articles, and financial world updates right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screens to download the app. Take a short break. Back on the other side. Still around 70 points lower on the Nifty, 230 down on the Sensex. ITC continues to remain among the top losers, of course, not just because of the block deal. Also, another factor why the stock is lower is because the stock is trading ex-dividend in today's trading session. So need to factor that in as well when it comes to analyzing the stock price. Bharat Dynamics, 2.5% lower on that stock as well. And Escorts Kubota is seeing a bit of selling pressure over the last couple of trading sessions, 2.5% lower on that stock as well. But moving on to earnings conversations, then SP Apparel is the next management on the show. The company saw numbers that were stable. Revenues were up 35%. The margins were also they were flat. Mr. P. Sundarajan, who is the chairman and managing director at the company, is joining in to discuss the road ahead. Mr. Sundarajan, good morning. Thank you for joining in. We'll start off with the top line, Mr. Sundarajan. You had reported a top line of 1395. You had guided for around 15 to 1600 crore. What led to that miss, and what are you envisaging for FY26 now?
Yeah, this is, we, after having acquired this young brand, so we have given this new number as an expectation. But in the core business, SP Apparels Limited, there was some challenges in, the shipments, this got deferred, because the customers wanted to push it to the next quarter or something. So that has, some of the shipments have happened immediately after the March. So this will come into this Q1 now. So otherwise, we are in line with what we have expected. And for FY26, yes, as we have been telling in all the investors that, we are looking at, after acquisition of young brand apparels, our capacity has grown by about, say, 1,300 machines, which is about 1/3 of the existing capacity. And now we are, we have gone into Sri Lanka offshore production, where we are planning for, already we have acquired one factory, and there are 2 factories already been signed MOU, and the 4th one is on the way. So by end of March 26, we will be increasing our capacity by 40 to 45% from offshore production itself, in addition to our India growth, capacity growth. That's our direction.
So would it be fair to assume that you would end the year 2,000 crores plus on the top line?
Yeah, if the capacity goes up by about 40 to 50%, so I think naturally we should aim for that, because our existing setup with the young brand one and the Sri Lanka operations, in addition to our increase in our existing setup, why it should not happen? We are aiming for it.
Mr. Sundarajan, you mentioned earlier that there were some delays in shipments that have now happened after March. Could you tell us what led to those delays from the customers? Have you been impacted in any form with this tariff flip-flop that has happened from the US?
No, that's not the case, because we, with regard to that, when we have booked some orders out of Sri Lanka during the last quarter, there are some difficulties in the acquisition setting up this shipments thing. So we had to literally, bring those orders back to India. So that got delayed. And we, as I say, that there has been always challenges in India with regard to the workforces. So the machines did not run as we originally planned. So that was also, there is a small slide. So which we have managed. That's the very reason why we are going to Sri Lanka, is where we are getting skilled up and running factory operators. So that's going to be a fantastic strategy, what we are hoping so.
So what does that do to the entire exports picture, Mr. Sundarajan? Because your exports business was almost around 90% of the overall top line. So what are your plans for exports this year? And if you could also tell us how much of your exports are to the US markets, and considering all of this tariff uncertainty that has been in place, what are the kind of conversations that you've been having with your clients on ground?
Yeah, see, after acquiring Young Brand is doing only American business, which contributes about, I would say, 25% of our total business. So American market is about 25 to 30%. The rest of all for the UK and the EU market, including Sri Lanka shipments. So now we are slowly looking at increasing the US customers also, because India's tariff is comparatively lesser. And because of this, anti-China and the Bangladesh thing, so that we are expected to get more business into India. And we are trying our best to increase the capacity in India as well. Because US, out of Sri Lanka, it is not possible at the moment because the tariff is on the higher side. And we are hoping for, bringing the tariff down again, back to 10%. If that goes, then we will have more shipments out of Sri Lanka as well to the US market.
You mentioned the UK as well. So with this free trade agreement that has been signed with the UK, what are the kind of synergies that you are expecting to come to you in terms of business opportunity from that market?
Yeah, see, already that's going to be a benefit to the customers, because we are not going to be benefited. So India will be getting more business as against Bangladesh and Sri Lanka due to the duty-free thing. And the challenge is the capacities for all the manufacturers, garment exporters. The capacity is a big challenge because the more orders are coming in. So we are looking at all the possibilities how we can increase the capacities within India.
Right. Mr. Sundarajan, what about margins? You ended FY25 at 17%, but your historical highs in FY22 has been 22%. Do you expect to get back to 20% by the end of this year, or because of the acquisitions that you have made, your margins would remain around that 17-18% mark this year as well?
No, it's like this, our back office expenses are on the higher side for the amount what we are spending in the back office for designing, sample purposes, marketing and everything. We should be doing at least about 2,000 crores in order to get the better margins. So we have been trying all these years along to improve the capacity up to about 5,000, 6,000 machines. But now by acquiring the Sri Lankan factories, straight away our capacity, we are expecting capacity to be about 7,000 machines from 4,500 in the next 1 to 2 years time. Automatically our back office expenses will hopefully come down by another 2 to 3%, which will in turn help us to improve the EBITDA margin to 20%.
So not this year, but maybe next year?
Yeah, it will start improving from this year onwards.
And what does that do to your debt picture, Mr. Sundarajan? Final question from mine. When do you expect to bring that down? The debt had seen a slight increase because of this acquisition. When do you see that tapering down?
Yeah, I think probably see the fact is what we acquired are already running full, so which means the return on investment, we are expecting it to be about 4 years of time. So in 5 years time, probably we will be able to get back all, including the young brand where we have acquired it. So all of this put together, the return on investment we are expecting to be about 4 years' time. So gradually that might come down.
All right, Mr. Sundarajan, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of SP Apparels on the road ahead for the company. Take a short break. Back on the other side with Abneesh Roy of Nuvama Institutional Equities to discuss the ITC block deal. Stay tuned.
To pay a hefty bill of 8,000 crore rupees to reverse flip and move back to India.
If the right answer for a business like ours is to list, then this is the right market.
Core business on the path to profitability, being able to actually nurture new businesses is the right time to take PhonePe to the public markets.
Welcome back. ITC is among the top Nifty losers after the company saw a large block deal where 32 crore shares worth 13,000 crore rupees changed hand. In fact, the deal even got upsized. Abneesh Roy, Executive Director at Nuvama Institutional Equities, now joins in with his thoughts and insights. What are the investor implications? Today, the stock price is under pressure on the back of this large supply, but BAT still holds significant stake in the company, which means that future stake sale is also possible. What does this mean for a shareholder in ITC?
Yeah, hi, good morning.
Good morning.
Yeah, so our thoughts on this is, this overhang of the BAT further, say around 23% stake will be there in the minds of investors because it's very high value. Because in March 2024, when the first tranche of sale happened, that time it seemed that this was a one-time event. And the investors were not expecting this. Now there will be a thought that maybe after a few quarters, again, one more tranche, can it come? That overhang will be there. On the fundamental side, things were improving. If you see in the cigarette, 5% volume growth in Q4 was a good number. If you see how many FMCG company in their core part of the business have seen a 5% volume growth in Q4, even Marico, which is a top tier volume growth, in the core part of the business, it is largely low single digit kind of growth. That's true even for Tata Consumer, which has also done well, for example. Most other FMCG companies are broadly at low single digits. So 5% volume growth was a good number. And palm oil price correction was a good news for ITC's FMCG business, which has been struggling last 2-3 quarters in terms of margins. We are still expecting that FMCG business will see a revival in terms of margins from Q2. Even paper business, if you see, which has been struggling because of Chinese imports, there we do see that Century Papers, that M&A, the approvals will come, and in H2 we'll see much healthier numbers. But this overhang now limits the stock more towards a bit lower PE multiple than earlier. So we will see clarity from BATs. It's something we need, whether this is the last tranche. Otherwise, you're absolutely right. 23% stake still means a lot of value, right? It's a 5 lakh crore plus market cap. 23% stake is a huge number. So that, I think, in the mind of investor will be a concern. Otherwise, from the government side, government clearly is making sure that the illegal part of the cigarette industry loses market share. And that's why ITC is reporting a 4-5% volume growth. Godfrey Phillips is growing faster in cigarette, but that's because they are a much smaller player and they are doing a bit of more trade incentive. So we are positive on ITC, but this overhang adds one more dimension to the entire aspect.
Abneesh, good morning. Thank you for joining in. In an ideal case scenario that BAT does clarify that it does not intend to sell any further stake in ITC for the foreseeable future, in that scenario, would you value ITC at a higher multiple? Because if that is an overhang that concises it to a lower PE, would that clarification result in a potentially higher PE for the stock?
Absolutely, it works that way because supply of stock for such a large market cap company and such large 23% stake left. Yes, if that clarity comes, the P multiples, etc., will be higher. Currently, if you see pre this announcement, we were valuing and giving a target price for ITC at around 532, and we were valuing the ITC cigarette business at 23 times P multiple and the FMCG at 6 times price to sales. Yes, now if that clarity is not there, we will shift towards possibly a lower multiple because that overhang is there. And on the vice versa, if we get that clarity from BAT that now, listen, we are done and dusted, then I think the investors will get a comfort and then the higher P multiple can come. Otherwise, the stock will be a more range-bound stock and it could underperform some of the other FMCG names where this kind of an overhang is not there.
What about ITC hotels? What stake does, BAT would have a similar stake in ITC hotels as well, mirror shareholding. What is your view on BAT bringing down their stake in ITC hotels?
Yeah, so there I would say that they have clearly maintained that hotels for BAT is not a core part of their business, not a core part of their overall portfolio. So it is a question of time. I would see that as a financial investment. So I would say that there is much more likelihood of BAT completely paring down ITC hotels versus, say, a cigarette company. But currently, if you see what our view is, and I cannot speak on behalf of BAT, the entire hotel industry is seeing very good times. It's in an upcycle. So what we think can happen is BAT would like to ride that upcycle maybe for some quarters and then take a call. But they've clearly mentioned that this is a financial investment, a non-core investment, the hotels.
All right, Abneesh, thank you so much for sparing time and joining us today to discuss the news of the morning, which has been that big block deal in ITC. For now, the stock around about 3% lower. Also just mentioned a few minutes earlier that it's also because the fact that it's trading ex-dividend, that's also weighing in on the price.
The dividend amount is?
Almost 6.25%.
So about half of the loss is explained by the going ex-dividend and half because of the supply pressure.
So there you can see there, ITC 3.25% lower, currently at 420. We call time on this edition of Trading Hour. We leave you with the Nifty around 60 points lower, still looking to recover from the lows of the day. From Rima, me and the team that put this show together, thank you so much for watching. Halftime report on the other side.